In the fast-moving world of finance, where markets swing wildly and news cycles change by the minute, one question often gets lost. What does it really mean to be an intelligent investor? The answer doesn't lie in chasing trends or timing the market. It lies in discipline, patience, and most importantly, mindset. Today, we explore the timeless wisdom from Benjamin Graham's classic, The Intelligent Investor, a book Warren Buffett once called the best book on investing ever written. By the end of this video, you'll understand the difference between investing and speculating, the power of a margin of safety, and how to build long-term wealth without losing your peace of mind. One of the first lessons Graham teaches is the difference between investing and speculating. Most people think they're investing when in fact they're speculating. An investor analyzes the fundamentals of a business, its earnings, debt, management, and competitive position. They seek to grow wealth over time. A speculator, on the other hand, bets on price movements. They're not interested in the business itself, only in what others will pay for it tomorrow. Graham warns, speculating is not necessarily wrong, but you must recognize it for what it is, and never speculate with money you can't afford to lose. Graham introduces a brilliant metaphor. Mr. Market. Imagine you're in business with a partner named Mr. Market. Every day he offers to buy your share or sell you his. Some days he's euphoric and offers absurdly high prices. Other days he's depressed and offers far too little. The intelligent investor doesn't let Mr. Market's mood dictate their decisions. Instead, they take advantage of his irrationality, buying when he's fearful and selling when he's greedy. The lesson: the market is there to serve you, not to guide you. At the heart of Graham's philosophy is the concept of the margin of safety. It's simple yet powerful. Always buy a stock for less than it's worth. If you estimate a business is worth $100 per share, you should only buy it at $70 or less. That $30 gap is your margin of safety. This protects you from error, bad luck, or market downturns. It's the ultimate risk management tool. As Buffett says, you don't try to buy businesses worth $80 million for $80 million. You try to buy them for $40 million. Graham divides investors into two types: defensive and enterprising. The defensive investor seeks safety and steady returns with minimal effort. They focus on diversified portfolios, blue-chip stocks, and bonds. They avoid complexity and aim to match the market's performance. The enterprising investor, on the other hand, is willing to put in time and effort to research and find undervalued stocks. They aim to beat the market. Most people should be defensive investors. Only those with the time, temperament, and training should attempt to be enterprising. Graham knew that investing is as much about psychology as it is about numbers. The biggest enemy of the investor is often themselves. Fear and greed drive poor decisions. Fear makes you sell at the bottom. Greed makes you buy at the top. The intelligent investor stays disciplined. They don't follow the crowd. They stick to their strategy no matter how others behave. As Graham says, the investor's chief problem, and even his worst enemy, is likely to be himself. So, what does it take to become an intelligent investor? It's not about being the smartest person in the room. It's about having the right mindset. It's about patience, discipline, and humility. It's about knowing what you don't know and staying within your circle of competence. Start today. Educate yourself. Build your margin of safety, ignore the noise, and, most importantly, stay the course. Because the best investment you can make is in your own knowledge, patience, and peace of mind.